For the longest time, we were told that cash is king.
Surprisingly, right now, cash is king.
Cash is king. Cash is king.
Cash is still king. This is not in the past.
And real estate is one of the few asset types that can produce a lot of cash flow. But as a passive investor, you're probably hearing from the operators that you're not going to get any distributions this quarter, or that new offerings right now are not getting any preferred returns. So why is that exactly? In this video, I'll be covering why deals are struggling to produce a decent amount of cash flow and what this means for your current investments. On average, 90% of the income from multifamily real estate is coming from rental income, and the remaining 10% comes from fees, parking, and laundry. And rental income is the reason why deals are struggling to produce cash flow, because rents are either declining or they're not growing. Back in March of 2022, the median rent was on average $1,900. That's 17% more than the previous year, and that made a lot of investors a lot of money. Since then, rents have been declining back to their normal levels. So what is causing rents to fall, and why is it so hard to raise rents? The answer is supply and demand. When there was a lot of demand for housing back in 2021 and 2022, there was an obvious shortage for housing. And many of those new constructions are coming online this year. When there are multiple options for renters, that drives up the competition for property owners. And in order to compete, they would either have to provide amenities, concessions, or lower the rents. You see, rents are very market driven. What I mean by that is you can only upgrade the unit so much where the asset type and market won't pay anymore. So you can make the units as luxurious as you want, but that doesn't mean the renters are willing to pay extra for it. The last point why you can't raise rents is because the median income isn't keeping up with the rental growth. Rent now accounts for 30% of a typical family's income. Let's move on to the second cause for low cash flows, and it is debt. Specifically the ones with variable interest rate. Back in June of 2020, the federal funds rate was essentially zero. Operators were using bridge loans to acquire properties due to its high loan-to-value ratios. And the only drawback to bridge loan is that it is a variable interest rate. Well, no one ever predicted that the feds would raise the interest rates as fast as they did. And as I said earlier, bridge debt can loan up to 80% of the cost. So you got a high principal payment and a high interest rate, both a very bad combination. As you can imagine, a lot of property owners are struggling to pay their mortgage. Some operators may already be tapping into their reserves just to pay for the mortgage. And if they're good operators, any cash left over after paying the mortgage is probably used to repay the reserves. And that is why they're delaying distributions. Lastly, it is because they overpaid. Back when values were soaring high in 2021 and 2022, operators were competing against each other and bidding up the price. Those who exit at the peak made a ton of money, but those who bought at the height are now in trouble. Their business plan may be to raise rents at a certain price point, but now they're not able to achieve those rents. What's worse is they're not able to sell the property to pay off the debt or to give a decent amount of returns to their investors because the value is not there anymore. So right now we're at a stalemate. Sellers won't lower their price and buyers are not willing to pay the asking price. So as a passive investor, is it bad to not get any distributions? I would say it depends. You have to understand that the main goal is to get to the point of sale. And that might be 2 or 3 years down the road. And in order to get there, sometimes there might not be any distributions because it's needed somewhere else. It is not worth getting any monthly or quarterly distributions only for the property to be foreclosed and the passive investors losing their capital in the deal. If you've been a follower of our channel, that is why we emphasize of working with sponsors that you trust. Because it is in times like these you need to trust in their decision making to implement the business plan and achieve their performance. So all is not lost. Real estate moves in cycles. The current environment we're in will not last forever. It might get worse or better, but one thing is for certain, change will come. So don't focus on the news or what the current returns are looking like right now. Because now more than ever, remember that commercial real estate is all about delaying gratification. The big payout comes when you exit the deal. And if you want to know what kind of returns passive investors are achieving when they exit the deal, watch this video next.